Welcome to an update for the Federal Milk Marketing Order 33. This is Dr. Lawrence Jones of FARME Institute, and I developed this program specifically for Nobis Agri Science. Now, I put these slides together yesterday on March 2nd, but I had to do a farm visit today, so I didn't get it recorded until this afternoon, 3rd of March. So some of these slides might be a little bit out of date because by now you've probably heard that there are 25% tariffs going on in Mexico and Canada starting midnight tonight. And if we just kind of look at the impact on the different markets, I mean, all the markets are tumbling, but this is the April contract for milk, and it has dropped off significantly. We had complete support at 18.50, and here we are now trading at 17.88 or something like that. So this has not been a friendly response to these tariffs. All right, I'll go back to kind of what I had prepared yesterday. This is the statistical uniform price for order 33, came in at $20.85. And again, that's a little bit worse than what we had at the end of 2024, but better than we had, basically all 2023 and 2024. Now, talking about statistical uniform prices, I wanted to kind of bring one more thing to your attention, and that is with the proposed federal milk marketing rules that are coming out, there is going to be an adjustment to the Class 1 differentials. So right now, you add $2 to your Class 1 price for order 33. That's going to go up $1.80 to be $3.80. So order 33 at Cayuga, Ohio is going to see a $1.80 increase in their Class 1 price. But it's not all good news, because if you go out to the different counties, and I picked Allegan in Michigan, right now you have $1.80, which is minus 20 cents off of that Class 1 differential. With that new increase, you're going to go up to $3.30, which means that you're only going to get $1.50. So going forward, instead of a 20-cent deduct, you're going to see a 50-cent location deduct. Now, it will still be higher by $1.50 than it would have been, but you're going to see a higher deduct for the different zones. So just finished up the January contract. Actually, February will settle up tomorrow. We're always a little late given the different reports that come out here. But just real quickly, there was carry in the January contract. 6 months out, it was $1.48 lower. And if we just plot out the carry, it's here. We had quite a long time of what I would call a bearish market, and then we popped out of it for a few months, and so we're back into it. I suspect February is not going to be quite as favorable. We talk about the emotion index. Somewhere in that red box is what I call just a nice quiet market. We jumped out in July of last year when things got crazy. We've been jumping out of it, and we were back in it, and I think now we're going to be way out of it again, because these markets have just been gyrating around as they come into closure. So here are the futures, and again, this is the settlement as of Friday, so this is a little out of date, but Class 4 is higher than Class 3, except for February. It looks like Class 3 is going to be a little bit higher, and there should be no depooling really until about November, because the difference between 3 and 4 is pretty small. But that also means that when we go to the higher of, anytime that this difference is less than $1.48, the higher of is a bad decision. So here are our blend prices, and again, these are probably a little bit lower tonight. Right now, we're looking at about a 89-cent drop from 2024, and I would probably guess that's going to be between $1 and $1.25 is kind of what I'm projecting for the year, a little bit lower than 2024. Here's our production of Class 3 and order 33. Again, it was very high, about 24.8 million pounds a day at our absolute highest. These areas down here are clearly depooling Class 3. We have been depooling Class 3, but it looks like we may have not gone back to the full Class 3 in the pool. It would have suggested that there would have been no depooling, because that's only a 39-cent difference between Class 3 and Class 4. So you were about, let's call it 21 million pounds, so about 3 million pounds short of what we were at the peak there. Again, Class 4 should not have been depooled, but again, anytime it's under about 8 million pounds a day, it's probably being depooled. And this comes up slowly because plants don't like to go in and out of depooling, and so they start depooling, and they need to see a good reason not to depool. But I would expect there be no depooling here as we move into the future. The big story, I think, in the industry right now is the components. Your fat came in at 444, and if we just look at what's happened with this over time, just incredible. A year ago, we were 429. This is the highest fat you've ever seen in order 33. It was interesting to read the AMS Fluid Milk and Cream Report for Central United States, and it says the contacts who spent noteworthy years in the dairy industry, that's meaning us old farts, have never seen anything like these milk fat levels. And so these are just historically high, going to have some significant down pressure on butter. Speaking of butter, I put together this spreadsheet. Again, you can stop and look at this, but what this is designed to do is to take these 4 components that we have as the basic components in dairy and follow the graphs as to how it impacts class 3, class 4, class 2, and then your class 1. And this won't match exactly because I did not do an advanced pricing for class 1, so it assumes these prices are in effect for basically 6 weeks. But what my interest was say, what is our price exposure to butter? So when we have 3.5% fat, so when we look at our class 3, class 4 statistical uniform prices, they're all at 3.5%. That represents about 48% of the total income. But you guys actually produce 4.44. So right now, your exposure to butter is about 61%. So it's that added fat that's in your milk check that's not covered by these major components. So if you're contracting milk into the future, make sure that you take into the fact that we have much higher fat than the 3.5. And again, the reason that's important is we're just seeing a collapse of the butter prices. You know, we've gone from 265 down to about 235, somewhere in here. And the way you read these graphs, the red dots are the spot market, the blue dots are the National Dairy Sales Report, and then the green ones are, you know, my predictions into the future here. And again, this was prepared on Friday. If we look at the forward curve on butter, it's very positive. You know, we're looking at 265 out here, Q4 kind of time frame. So again, there's a very good carry in the butter market. Now, protein is also gone kind of ballistic here. What I had said before is that we'd been increasing the lows and holding the tops about flat. Well, that's not true right now. We came up to 3.39 again. That's going to be the highest that you've ever seen in this order. And last year we were 3.32, so phenomenally high protein. Kind of turn to some of the bigger picture things in the industry right now, and this is the cow numbers. With his last milk production report, we were about 9,365,000 cows. That's up 41,000 from a year ago. But again, I look at this graph and I see a couple different things. You know, that's one of our lowest points. So saying we're up 41,000, I'm not sure is that an accurate scenario. So with this data, we can actually look at the replacements per cow. And right now, I've got it estimated at 0.74 per cow. Again, if you divide that by 2, because it takes 2 years to get replacements in, that's 37% replacement rate. Take away a 7% death loss, that says, you know, to keep the herd static, we need to be at the 30% call rate. And that's exactly where we are. When you look at the last slaughter data for the 9th of February, we're 53,534, 8,000 fewer than a year ago. But we're right at this 29% call rate. So back here where we're 30-32 is when we were losing cow numbers. And so now that we've gone to this 29% call rate, we're actually maintaining cow numbers. So milk per cow across the nation has been on a significant uptrend, you know, from 2016. But then about 3 years ago, we cut that trend off and we're trending down. And so we've been very flat in milk per cow. And when I look at this graph, it's like, tell me where bird flu actually hit. You don't see a big bump or anything in this graph. So I'm not sure that bird flu at the end had a significant impact on milk per cow. It's just one of the things that's adding to the entire picture here. But the reason that we've got lower milk per cow is we've got increased components. And so to get 7 pounds of components, you need a lot less milk per cow with these high component numbers. And this is depicted in this fat percentage. Again, we were going up on a very good uptrend, and then 3 years ago we just broke this and just really shot up. And it actually came in a little higher than we thought it would on the January data. So this is very, very strong across the nation. This is total production, and it's going to be exactly the same because it can mirror a milk per cow and number of cows. So on this significant uptrend, and then we broke that uptrend, and we've been very much on a downtrend. I consider this to actually be a little bit bullish because, again, we've controlled the industry and we're not way overproducing milk at this point. We also got the cold storage report. I'm going to focus on cheese first. We added 19.9 million pounds to cold storage. And so the question is, is that good, bad, or indifferent? Well, first off, if we look at the December numbers, USDA actually revised those down. And so we actually put in less cheese than we did last month, but we made about 2% more milk on a per day basis. And part of the question I always ask is, was there a good reason to put cheese in the cold storage? So this is back to the 17th of January, right in the middle of January. We ended up with a January cheese price of $1.89. From $1.89 to put it in cold storage and pull it out, we need to be like $1.96. And the futures contracts weren't suggesting that. So there were no good hedge positions. So the question is, why did somebody put cheese in cold storage? Multiple reasons. Maybe they needed to keep their plants going and they didn't want to sell it on the market. But it's also possible that they are thinking about some good spec positions that, maybe out here in Q3 that this price is going to come up. Now, with heifer shortages, that's very realistic. With new cheese plants, that maybe not more realistic, but it's always something we have to think about. Cheese stocks have been climbing for a number of years. We were up to 1.5 billion pounds of cheese in cold storage. And just like everything else, we've been peeling that back. Now, we were up a little bit more than we thought we would be in January, but again, we were down pretty significantly here in December. So I'm not at all surprised that that came up just a little bit, but the trend is very much on a downward trend. And again, I would consider this bullish because we're not producing a ton of milk and making a ton of cheese and put it into cold storage. We've got it all under control. Butter, we added 56 million pounds. That's right where StoneX had it. They were 55.7. I was thinking that would be more like 3.7, but again, my reasonings was, looking at demand and some of these sorts of things. But if we look at butter stocks, we've just been on this tremendous uptrend, and that really hasn't broken. Now my line broke a little bit here, but again, it's just on this tremendous uptrend, and we've just been on it, and we're continuing on it. And part of the reason that we should have been adding butter to cold storage is we were at 260 in January, and this is the again the graph as of the 17th of January. There's some excellent hedge positions, so you could have put that in cold storage, sold the September contract at 285, and just kind of sat there and leave it in cold storage because you've already got it sold at 285 and at the end of Q3, beginning of Q4. The other thing that I like to kind of keep an eye on is the spot market. And a lot of people say, well, why do you spend time on that? Well, this is the correlation between what the National Dairy Sales Report comes in orange and the spot market basically in blue. And so you can see that these are very highly correlated. Now, there are times, where they miss a little bit, but again, they give you directionality and have pretty high correlation. So if we look at the last 2.5 weeks of spot market, we were in this $1.85 kind of trading range down to $1.80 up to $1.90, except for Friday. And then on Monday, this really kind of came down. So one of the questions that I'm pondering and I've got some people looking at here is, again, the red dots are spot market, the blue dots are kind of the reality. That's a National Dairy Sales Report. Again, I've got a 2-week lag built into this. We had significantly low spot market here, couple here, but if we look what happened in the National Dairy Sales Report, it just kind of clicked right along up here and ignored these points as if they never existed. And part of the reason is, we can sell 100,000 pounds on the spot market down here very low, but National Dairy Sales Report is about 12 million pounds a week. So again, it's fairly insignificant, and sometimes it just doesn't follow. And this is a good example here. And I'm not sure with this Monday, and if we go into Tuesday, that's really low, then the spot market might have to pull the National Dairy Sales Report down. But right now, I'm expecting this National Dairy Sales Report to be like $1.84. And just again, a couple comments about this. Most of these have been one company selling. They just get to a point that they just want to dump cheese, and you can tell it when you're watching the spot market. It goes down a penny at a time when everybody else goes down at a quarter of a penny at a time. In the action day, there were 10 loads sold, and it was actually two companies. It was the same company that was back here, and then another company that doesn't normally sell on the spot market. And so we were wondering if that was related to the tariffs or something else. I just wanted to dump cheese and get rid of it. But we'll find out here in the next day or two. So here's our bigger spot market for cheese. We had this channel that we built back here. We've got a new channel here. Now we're at the bottom of it, and we probably broke out of it today. But we had this run up, run down, and one of the questions I keep asking is, why did that happen? And I've put together some things here to try to figure it out. And one of the things I don't have on here is demand. And so we're going to have to put this together a bit more. But if you want to stop and look at these, there's nothing that describes why the cheese should have went from $1.97 up to $2.28, and then right back to $1.76. Cow numbers weren't out of line, production wasn't out of line, the percent of the cheese that was Italian wasn't out of line, and cheese stocks were pretty well continuing to come down. So that was all emotion, and I think that's what's going on in the market right now. I think it's going to be sell the rumor and buy the fact here. Now, whey prices have been falling. We've gone from 70 cents down to about 50 cents. And so using that spreadsheet that we were looking at a little while ago, I asked the question is, what impact does this have on order 33? Now, we know that 20-cent change is probably $1.20 on class 3. But again, your class 3 is only a proportion of what you make. So this is about a 70-cent drop in your total milk prices, going from 70 cents down to 50 cents, so about 70 cents a hundredweight. Non-fat dry milk, which is your class 4, has been also falling off. It went from $1.40 down to $1.20. And again, you don't have a lot of class 4 in your order. And when we talk about the spot market, we always like to compare it back to the global dairy trade. Now, we'll have a auction on Tuesday, tomorrow, but right now the last auction was down about 0.6, so down just a little bit. And I've got in green everything that has a big enough difference to actually be exporting. So we should be exporting butter, which was $2.35 versus $3.28 in the world market, cheddar at $2.21 versus $1.78, and that's probably like $1.72 now. And non-fat dry milk at $1.33, and we're at $1.20. So overall, we should be exporting some of these major components. And we always keep track on this by plotting out the global dairy trade in green, and then the National Dairy Sales Report in blue here. And so there was enough difference in January to give us a black dot, which is suggesting that we should have exports. We had some exports back here and additional exports back in the middle of 23. Just touch on grains for a second. We were down about $11 on the corn market, down about $3.23 Friday over Friday on the soybean market. But again, these were the Friday prices, so it was a risk-off day. Everything was down fairly significantly. But I wanted to put in this, what I call my PE index, which is 8 pounds of cornmeal, 8 pounds of soybean meal. I feel anytime it's under $2, which is what this red line is a favorable condition for dairies. And we've been there more or less since, let's call it February of 24. Now, yeah, we came over it for just a little bit, but more or less we've been under that $2 for quite a while. We talk about grains, and always going to worry about, are we going to go into the spring with kind of a drought condition? So there is, some significant moisture concerns. Through much of Order 33, Upper Michigan actually appears to have a fair amount of moisture in the root zone, but there's definitely a patch through here, through the I-states, through Ohio, particularly the southwest Ohio. And again, this was as of Sunday, but this was the European precipitation forecast, and it does look like we're going to get some rain up through here where we desperately need it. All right, that's kind of a big load that I gave you today, and I apologize if this got a little bit longer, but there's a lot of things going on in the industry. So I want to thank you for watching this, and I will get you another report about this time next month.